All right, let's now continue with our business news. And personal finance advisory firm, the Interest Rates Advisory Center, or IRAC, is warning that banks could be hoodwinking borrowers into paying higher than intended rates of interest on loans under the new law. In an exclusive interview with KTN News, IRAC CEO Wilfred Onono points out that the new law references the Kenya Banker's reference rate rather than the central bank rate that banks seem to be using to interpret the new law. Well, that mistake, he says, could cost borrowers an extra 1.5% of interest. Well, he spoke to KTN's business editor, Peter Wakaba. Take a look.
The KBRR rate, in my view, is the correct base rate to be used in computing the interest rate. It is described by the central bank as a uniform base lending rate for all banks. This is the rate which all banks have been using to price their loans since the year 2014, when the central bank introduced the KBRR. The central bank rate has been around for some time, and that particular rate is the rate the central bank uses when it's lending to the banks, or vice versa. So it has nothing to do with bank-borrower relationship. The only rate that is being used in determining the rate of interest to be paid by borrowers from banks is the KBRR, and therefore, in the Act, reference to base rates, in my view, should be KBRR.